everybody. Thanks again for joining us, and just as a reminder, we are trying to record this presentation starting now, so if you don't like that, leave the room. I'm taking the easy way out on today's introduction. I'm going to introduce Mark McClellan from AQR Capital. Mark's been fantastic working with throughout this process. When you coordinate speakers, sometimes logistics are easier than others, and I really need to commend Mark. He's been fantastic to work with. And our originally scheduled speaker had something come up that he wasn't able to join us today, and that's the call that every programming chair dreads a week or two before an event about a possible cancellation. But these guys were great, and Dan agreed to come out on kind of last minute and has given this presentation plenty of times before, including to Philadelphia. So we're in very good hands today. Like I said, I've seen the presentation, and I think you're going to find it one of the more interesting ones that we've done, and we're going to reserve plenty of time at the end for questions because I know it's a timely topic. So with that, I'd like to bring Mark up here to introduce Dan. Thanks.
All right, well, thank you very much. And Jim, thanks to you, and thanks to everyone for having us. We certainly appreciate the opportunity to talk to everyone today. As Jim mentioned, my name is Mark McClellan, representing AQR Capital. AQR is based in Greenwich, Connecticut. I am actually based in Chicago. I know some of the faces here, and so good to see you again, and to the others, just thanks for being here. We certainly appreciate the opportunity. As Jim mentioned, Dan Vitellon will be the speaker today. Dan is part of our, in true AQR fashion, he's a University of Chicago MBA, and then also part of our what we call our Portfolio Solutions Group. And their role is really sort of twofold, where they create much of the intellectual capital and content from our white papers. I don't know if some of you have read our white papers and whatnot, but create much of that content, much of the research that goes behind that, and much of these presentations as well. And then also they work with different clients, prospective clients, on custom analytics, policy issues, these types of things, really trying to add value from that perspective as well. So Dan, like Jim mentioned, has given this presentation a few times. Well versed in the topic. He actually co-authored the Chasing Your Own Tail Risk white paper along with Adam Berger, as well as other white papers. So we've been giving this presentation here recently. It's certainly a timely topic. There's always, I would argue, uncertainty in the world, but right now, one could certainly argue there's heightened uncertainty and questions about tail risk and whatnot. So hopefully you find this valuable. We appreciate the opportunity, and I'll bring Dan up at this point. Thanks a lot.
Yeah, I should open with an apology. I have two dogs, and when I eat in their presence, I assume something really bad is going to happen. And so here we have the most vicious dog I could find, and you guys are trying to enjoy your salads, and he has ferocious teeth. But the point of the cover here is just, a lot of investors have this sort of rabid, myopic approach to hedging their tails, and we think that can be sort of destructive to portfolios. So in this case, we like to joke the dog's tail is a bit longer before the picture was taken. Okay, so we'll just get right into it here. To illustrate what we're talking about with tail risk, I'm showing the annual return, and we can kind of think of three main ones. The first is to be opportunistic in a crisis. So, if you think of yourself as sort of the long-term investor, the one who provides liquidity in a crisis, the one who captures these fire sales, it makes sense to have puts because you get cash in a crisis when expected returns are highest, and you can put that to work. We think that a more efficient way of having cash in a crisis, rather than owning puts, is just to hold extra cash because you're going to have it, and you're not sort of paying to hold that optionality. The second is for short-term constraints. These are real things. These are constraints like when markets are down, your clients are panicking, and they want you to do something. You've suddenly gone from having a fairly long horizon to having an extremely short horizon. just when that horizon change is the worst. So an option buying strategy could potentially protect you from ever reaching those times of being forced to kind of get out of risk when risk is kind of at its most attractive. And third is if you think you can add alpha to an option buying strategy, if you think you can tactically time and beat the options market, that might be a reason to be in an options type strategy, but we really think of that as a form of market timing and not really portfolio insurance. So, returns of a 60-40 portfolio over the past 22 years, and you can see it's fairly well behaved, but in 2008 something horribly wrong occurred. So we're going to take a look at where this came from. The green bars here are a bond portfolio, and you can see quite clearly that's not the culprit. Not surprisingly, the next one is stocks, and you can see this is really what was driving the tail event in 2008. But beyond this, there's an interesting thing taking place. If you look year to year, it's really equities that's driving the variation in your 60-40 portfolio. You can see if equities go up, the 60-40 does as well. And interestingly, there's a 0.98 correlation between equity returns and then the returns of a 60-40 portfolio. So from one perspective, you can kind of think of 60-40 as just watered down equities. You're getting the same behavior, but with 60% of the return because that's what's in equities. So the point of the presentation is to look at ways of mitigating that red event there. We're really talking about equity risk when we're talking about tail risk. So we'll look at sort of the traditional way of hedging equity risk, and that's just put options and other forms of insurance. So as CFAs, I'm sure you guys are more than familiar with this, but here's sort of the classic put diagram. You know, in theory, when the asset that is protecting depreciates, it pays off. So that's the left side of the screen. And if the underlying asset does fine, it obviously returns you nothing, and you've forfeited that equity premium, or the option premium. So theoretically, this is how it works. Next, we take a look at how it's worked empirically. So this is the monthly returns of puts on the S&P. There's a lot of ways you can structure this. We just did it kind of generally with 7.5% out of the money puts. And so the first question is, did it work? And clearly it did. If you look at the left side of the screen, when equities had very bad returns, the put options made money. So then you have to look at the right side, and you can see that the returns have been substantially negative there. And in fact, the annual return to a put option strategy like this one has been negative 5%. So going forward, if you have an expectation for the equity risk premium, you have to wonder if it's much above 5%. How much of the return from equities are you forfeiting by hedging your downside? So this looks at it across the long term. Here we look at it through time. Two things come out here. One is that a put option strategy rarely is a money-making strategy. It really takes something like the financial crisis there for this thing to generate positive expected risk-adjusted returns. The second thing is that, the Sharpe ratio of a put buying strategy gets particularly bad right before you need it. You can think of the difficulty of sticking with a negative expected return strategy through time, but it's an awful lot harder to stick with it in 2005 when you've had a -4 Sharpe ratio over the past 3 years. So now we just take a look at how it does with the S&P. These are two lines. The blue is the S&P, the red is the S&P fully hedged with puts that are 7.5% out of the money. So obviously when equities do well, that's the white puts are going to be a drag on performance. That's what they're designed to, how they're designed to behave. But take a look at the blue lines there. That's really what investors care about. That's when equities have had poor performance. And so here we put on some numbers to show what losses have been. And my apologies to everyone on the back tables there. So there's kind of two things that stick out here. You can see that indeed in the financial crisis, puts did protect you some. You still lost money, but you didn't lose as much money as you did just holding equities. But take a look at the tech bust. That's a similar equity drawdown. You've lost 40% of equity market value, and your hedge portfolio also lost you 40%. And that's because the options market it's a pretty smart market. It will adjust to what its perceived level of risk is. So when you want puts, they tend to become more expensive. Okay, so I feel like I've been doing a lot of put bashing. There are still completely valid, rational, and good reasons that you would want to initiate some sort of tail risk hedging program. And we can kind of think of three main ones. The first is to be opportunistic in a crisis. So, if you think of yourself as sort of the long-term investor, the one who provides liquidity in a crisis, the one who captures these fire sales, it makes sense to have puts because you get cash in a crisis when expected returns are highest, and you can put that to work. We think that a more efficient way of having cash in a crisis, rather than owning puts, is just to hold extra cash because you're going to have it, and you're not sort of paying to hold that optionality. The second is for short-term constraints. These are real things. These are constraints like when markets are down, your clients are panicking, and they want you to do something. You've suddenly gone from having a fairly long horizon to having an extremely short horizon, just when that horizon change is the worst. So an option buying strategy could potentially protect you from ever reaching those times of being forced to kind of get out of risk when risk is kind of at its most attractive. And third is if you think you can add alpha to an option buying strategy, if you think you can tactically time and beat the options market, that might be a reason to be in an options type strategy. But we really think of that as a form of market timing and not really portfolio insurance. So AQR was approached by a public plan a couple years ago to come up with a put option buying strategy for them. And so we took a look at the numbers, and they're reflected in the graphs that you saw. And we couldn't really come up with a good long-term case for being a buyer of insurance. So we started to look at some alternatives. And here we have kind of 5 general alternatives, and I'm happy to get into specifics on any one. But they're roughly broken up into 2 categories. One is a lack of diversification in the portfolio. And that's sort of, if you think back to that 60-40 chart, the thing that's really driving your day-to-day variation, your month-to-month variation, and your annual is really equities. So to the extent that you can reduce your reliance on that one risk, the better your chances are of surviving a tail event in that one asset. The second is just risk management, and that's just either having a plan for when these things happen or modifying the portfolio through time to adjust to the risk in markets. So the first one gets to that sort of 0.98 correlation between equities and a 60-40 portfolio. As I said, if equities do poorly, your portfolio is going to as well. And to illustrate that here, on the left, we have sort of we've got the purple inflation risk. That could be TIPS, it could be real assets like commodities, and the dark blue is credit, corporate bonds, things like that. So the portfolio on the left looks pretty well diversified, but because each of those slices has a different risk, it doesn't behave like a diversified portfolio. Equities are 3 to 5 times riskier in volatility terms than bonds, And so when you look at the behavior of the portfolio, it's predominantly going to be driven by equity markets. So one way of reducing your exposure to equity risk is to diversify the portfolio by risk, not just in dollar terms. So what does that look like to the returns? Somewhat surprisingly, different risk premia have had fairly balanced risk-adjusted returns over the long term. So here we look at 40 years of data, and I'll talk about kind of shorter time periods, but the Sharpe ratio of stocks and bonds and commodities have been roughly similar over the past 40 years. So if you can get an equal risk exposure to these things, you can really monetize the benefit of diversification. So diversifying by risk, it doesn't necessarily mean that you're giving up on expected returns. Over any shorter period, an important question to ask is, what your confidence is in equity risk premium. So it's notoriously hard to come up with what you think the ending value of the S&P is going to be for the year. But over the longer term, you know that stocks should have a nice kind of a low correlation to assets like bonds, for instance. And so if you have more confidence in correlations than expected returns, sort of an equal risk approach is a fairly natural way to go. I should have mentioned up front that if you have kind of questions, feel free to ask throughout. So our second one here is another way of reducing your risk from equities is to invest in lower risk equities. And so these are defensive equity strategies. You may have heard of them as minimum variance, low vol, stability. They all kind of get to the same thing, which is that lower risk stocks don't necessarily give you lower returns. And so this is a finding that goes back to Merton in 1972, and so now we have 40 years of out of sample evidence. And so the chart here, this is using CRSP data from 1926 to 2009, and what we do is we break up stocks by beta. So we take the beta of all the stocks and we just arrange them into deciles. So on the left we have the 10% lowest beta stocks, and on the right we have the 10% highest beta stocks. CAPM tells you that beta is really the only thing that matters as far as pricing risk and expected return. And this chart says, beta does a good job telling you about risk. The green bars show the volatility of these beta sorted portfolios. So the higher beta portfolios clearly have more risk than the lower beta ones. But it doesn't tell you much about return. That's the blue bars there. You can see that there's not a clear relationship between beta and return. So the orange line at the top there, that's just one divided by the other. That's the Sharpe ratio. So you can see that these kind of lower beta equities have actually produced higher risk-adjusted returns. There are a few theories for why this might be a rational explanation. One is leverage aversion, and that is investors seeking high returns are going to gravitate toward higher risk stocks. If you can't use leverage, in theory, that's the only way that you can kind of get returns. People won't really like the low risk stuff because in order for it to matter to them, they'd have to use leverage. And if they're constrained from using leverage, that creates a structural preference for the high risk stuff. So those prices get bid up, the expected returns come down, and vice versa for the first decile there. That argument's nice. The leverage version is nice because you can test it across asset classes and across global markets, and it's something that holds up, independent of other factors like value and size and momentum. So to take a look at what the returns of a defensive approach have been, we have a hypothetical strategy here, and we just compare it to the MSCI World. you can see sort of two regimes, the first one going up to 2000 and the next to present. And it kind of keeps pace with world equities in the first half of the sample there, which is actually a good thing because this low beta portfolio has a 0.7 beta to equities. So you've gotten to the same place while taking 30% less equity risk. Where the strategy really earns its keep is when equity markets decline. That's when sort of it's good to be obviously a low risk investor. And not surprisingly, these strategies had a great year in 2011. So the third is to invest in truly alternative strategies. And this is, it's weird coming from someone who works for a hedge fund to say this, but a lot of hedge fund strategies are not as alternative as they make themselves out to be. If you look at the returns of an alternative manager and you compare it to an equity index, you'll notice by and large that there's a perhaps shockingly and scandalously high correlation to equity markets. So that's what we've done on this page here. The bars, the two, I guess, leftmost set of bars are the HFRI hedge fund and fund of funds index, and the rest are the Dow Jones, Credit Suisse, used to be the Credit Suisse Tremont indices, and they're broken up by style there. So the green lines are what the past, from 2000 to present, what the correlation equities have been, and the blue are more recent samples. So you can see, in most cases, there's an extremely high correlation to start, and it's actually gotten worse. We think that as more assets have crept into alternative strategies, a lot of these supposedly long-short managers, if they're capacity constrained, a very high capacity way to get returns is just to invest with equity markets. And so it's not too surprising to us that you're seeing this correlation creep. However, one strategy, managed futures, you can see there, it's done a pretty good job of being neutral to movements of equity markets. And because of that, we really think of it as a true alternative and one that would do a good job of reducing equity risk, which is, we think, the biggest source of tail risk in institutional portfolios. So here we show, this is just a simplified managed futures strategy, just to illustrate kind of what the return profile looks like. And so the green dotted line is what we call the managed futures smile. It's a trend following strategy, so it tries to position itself in a protracted declining market short, because it relies on finding those trends, and conversely long in a bull market. And so, in 2008, Q4 2008, that's the upper left corner there, you can see that this thing did great because it had time to position itself and was on the right side. It doesn't always work. 2011, for instance, it was difficult for managed futures managers across the board because there were no real trends to grab onto. It was sort of a choppy market. So, its benefits really occur in sort of tail types of worlds. So the next one, now we're moving away from just diversification. This is more in terms of risk management. And this is sort of volatility targeting. And I guess an example would be if I were to come to Indianapolis in January and again in August wearing jeans and a sweater, I haven't really prepared for kind of these two regimes. Yeah, I've prepared for being comfortable on average, but I'm not really paying attention to the real world. And we think that a passive exposure to equities is a similar thing. You go through these high volatility regimes and low volatility regimes, and so you have a constant amount of capital invested, but you have different levels of risk invested in the equity markets. You're effectively letting the markets determine how much risk you're taking, because you're just along for whatever volatility is being offered. We think as far as tail risk is concerned, if you're able to reduce your exposure in high vol environments, when tail events are more likely to occur, you can effectively make sort of your expected distribution of returns a bit more well behaved. So this all sounds quite theoretical, so I'm going to make it even more theoretical by showing a graph here. So this is the volatility of the S&P through time. So you've just put $100 in it, and you just sort of set it and forget it. And this tells you what the annual vol has been. And so one, you can see that it's not equal. It goes through these spikes. So the four blue bars there highlight the periods of the highest volatility. And so that covers 5 years. There's 1982, which was the kind of the inflection point between the bear and the bull market. 1987, obviously, the crash caused unusually high volatility. You have the tech bust, and then the last 2 years of the 2000s there are one bar, and that was the financial crisis. So over this 31-year period, you've taken a certain amount of risk, and we show what that is in those red numbers at the top there. So in 1982, for instance, 5% of all of the risk that you were taking in this 31 years came from that 1 year. If you look at the financial crisis, 21% of all the risk over the past 31 years was in that 2 years. So these 5 years in total, that's the number on the right there, contributed to about half of the risk that you're taking over a 31-year period. So unless you have a view that these risky times are going to be particularly good for your portfolio, it might be better just to dial down the risk to have a steadier ride. We think that it's a big step in kind of reducing your tail risk. So this next line, we built a volatility targeting model. So the nice thing with volatility is it's fairly well behaved. The red line, it's not random. You kind of go through these spikes, and it's fairly predictable. Your best guess of the next period's volatility is pretty much what this period's volatility is. The return of this week's this week's return of the S&P isn't going to tell me much about next week's return, but the volatility this week is going to tell me an awful lot about the volatility next week. And so with that, you can kind of make adjustments to your portfolio. And so here in the blue, we have a simple volatility targeted approach that looks at the past 6 months of vol and tries to make it equal to the past 10-year vol. So if the past 6 months have been a 30 vol for equities and the past 10 years has been 15, then we're only going to take 50% of our equity exposure to make those two equal. So you can see it doesn't do a perfect job, but it does a much better job than the red. In those 5 years, it took 24% of its overall risk. Theoretically, if you could do it perfectly, you'd have that number at the bottom, which is 16. So the natural question is, how much of my expected return am I giving up by trying to reduce these tails? And so the answer is not a lot. There's not a clear relationship between the volatility of equities, say, and the returns or the risk-adjusted returns that they offer. So volatility targeting does not mean selling selling on the lows and buying on the highs. And so similar to the defensive equity strategy, you kind of see two regimes here. 1980 to 1995. It kind of keeps pace. It underperforms certain parts. It outperforms certain parts. But the important thing is here, it's doing it with much slimmer tails. The kurtosis for kind of the quant geeks in the audience here of the daily returns goes from 51 to 35. So it's an appreciable reduction. Everyone knows that daily returns aren't normal or anything, but it's just to give an illustration of kind of the reduction in tail risk there. Okay, so finally, this is in gross contrast to the quantity one that preceded it. This is just to have a plan for when tail events do occur. We found a lot of institutions and other managers, their plan for a crisis was to ride out the crisis. And we found that that didn't exactly work well. I'm not a great poker player, but I've heard an expression, sort of the strongest weak hand, and it's the person who tries to play the hero and ends up, for whatever reason, having to fold at just the wrong moment. So so we call this sort of everybody has a breaking point slide. This is why long-term investors end up behaving a lot like short-term investors. So endowments, theoretically the longest-term investors, they have the infinite horizons. They should be taking advantage of all these crises. There are reasons that they can't. And so we break these down into three. One is just purely rational economic reasons. So if you have capital commitments, you sometimes you can't afford, your kind of margin of safety has gotten so compromised that you're going to have to dump your risky assets when they're at their lows. The second are kind of I guess more sort of personal and institutional reasons. You could be running all sorts of reputational risks. Your board or your clients could be getting extremely frustrated that you're delivering the risk that was advertised, but not the returns that they had expected. And then the last we call the 7 stages of investment loss, and these are just sort of the self-doubt and endless committee meetings to determine when to get out of the markets. Our greatest fear is that whenever the decision is made, it's usually going to be a lowest common denominator kind of a thing. You would have had to reach consensus, which takes time. Meanwhile, everyone's doing the same thing, and so the time to cut risk has come too late. So to illustrate what we're talking about there, this is a simplified example of 2 types of crisis management. So starting with the top, the red line is the static approach. This is the strongest we can. That's, in theory, you're just going to ride through the crisis. You're a long-term investor. That's your role. You're supposed to make a premium by being a liquidity provider. But what we find is in the depths, there are these reasons, economic, institutional, that you're suddenly forced to do something, and it's usually to cut risk. And we think that in addition to cutting risk, perhaps too late or perhaps by too much, the flip side is you need to wait for another committee decision to figure out when to put risk back on. And there's no clear signs, obviously, in markets of when it's safe to get back in the water. So our kind of preferred approach is just to have an explicit drawdown control in place so that you have sort of a systematic guideline for when to cut risk and by how much, and importantly, when to get back into markets. So there are a lot of ways of doing it that it's sort of similar to like a stop loss, where you basically look at how much you've lost relative to some floor and compare that to the risk of the portfolio. And when that ratio goes below a certain threshold, then it might be time to reduce your position sizes by 15% or 10% or something like that. We think that sort of cutting earlier and cutting smaller will prevent you from reducing as much risk as the static, kind of the set it and forget it guys in practice. And it also gives you a discipline for getting back into the markets. So just to illustrate, none of the things I talked about are designed to be perfect hedges. Puts are designed to be perfect. They have a payoff structure that you can track what it's supposed to be doing. These are kind of imperfect hedges. Managed futures, for instance, can be caught off guard if you have a sudden drop in returns. Defensive equities still have equity risk, so it's not a complete tail risk protector. So these are imperfect hedges, but they're cheaper than explicit insurance, and we think a diversified approach to them, the constituent parts put together, can create payoff like a put options, but without the explicit insurance cost. So just to have some numbers here, we just compared kind of a global 60-40 portfolio. What happens if you're purchasing puts, and we have sort of 2 lines there, the performance and tech bust. performance in the financial crisis. And then we have 3 strategies that seek to do some of the 5 things that we talked about. And just to show kind of their performance in each of those regimes, you can see that they behave differently in each regime, and that's why sort of the combined approach is our favorite. And then so this is sort of the why you want to do this and why a lot of people can't do this slide. So we think it's good risk management. However, you know, it's a lot of these things are benchmark agnostic, so it's tricky for a lot of people to follow. There are reasons that because a lot of people can't do this, there should be a premium to doing it as well for, you know, the few people who aren't as constrained. The liquidity and transparency of these things is different. You know, managed futures, you are starting to see them in mutual fund formats, but you know, historically that's been the realm of CTAs. But we think these approaches are sort of they're preferable to long-term and even short-term investors because they're things that can proactively reduce the chances of you being forced to make sort of imprudent decisions in a crisis. So with that, I'm happy to take any questions on any of these things. Yeah.
I had a couple of questions. Have your strategies been tested in inflationary versus deflationary environments? And I have one follow-up question.
Okay. Yeah. So the question was if these strategies have been tested in inflationary and deflationary environments. These ones here are kind of mostly deflationary hedges. That's what I guess if you think of the world as sort of a distribution and sort of the middle of it is normal kind of benign inflation, benign growth. We think of the inflationary as one tail and the deflationary as the other. These are really just focusing on one of the tails. We find though that 60-40 portfolios tend to be bets on benign inflation and growth. A lot of people think of stocks as a great inflation hedge. We find the risk-adjusted performance of them does degrade when inflation is high. And so sort of the diversify by risk approach, I showed kind of the bonds, stocks, and commodities. That does a bit better in runaway inflationary environments because you have that real asset exposure. So that one's a win. The managed futures tends to do okay. It does better than most kind of static strategies. But you know, a lot of the ones that are just focused on one tail tend to be at the expense of the other. So if it's inflationary risks you're concerned of, you might want to look more at kind of real return strategies, things that focus more on kind of the hard assets.
The other question I had was, so you're advocating when you're expecting volatility to pick up, reallocate a portion of your equities towards cash, I believe?
Yep.
And the trigger for that, I didn't quite understand.
Yeah. So
Mechanical trigger, I guess.
yeah, the second question was on the volatility targeting, and there are a lot of ways you can set it up. You know, to make it sort of turnover sensitive, you can have rules in place, like you're only allowed to rebalance monthly or quarterly, or if the current volatility is 10% off of what your target is. So in the example shown here, it was every month you rebalance in order to achieve your target volatility. That was just sort of a simplified example. There are kind of ways you can bring down the trading there, but the one I showed I think has about a 90% turnover. So it obviously wasn't optimized to be kind of used or anything like that. But I have seen approaches that only will sell equities when vol is high, rather than increase your exposure when volatility is low, and that would be kind of more of a kind of tail risk kind of focused approach.
So the example that you showed also plot with vol as well.
Exactly right. Yeah. Thanks, Charlotte. So I'll go back to it. So let's go to just this one here. So this is just the buy and hold version. You can see in the mid 90s, equity vol was kind of high single digits, and then early 2000s it was twice that. So if you want to target kind of the long-term average of equities